So a big concern among investors that I'm talking to is that they think that the increase in interest rates recently is going to drive an increase in the cap rates. And as the cap rates go up, the value of commercial property goes down. And the truth is that, at least looking at the last 40 or 50 years of data, there's no evidence to support that. So let's take a look at what the truth of this is. First, I asked people, if you don't make an investment in real estate, what are you going to do with the money? And what I hear most of the time today is like, well, hey, the Dow's fallen by 24%. It's a buying opportunity. I think I should put more money in the stock market, not in real estate. So this is a chart of an analysis from JP Morgan, where they took a look at the last 14 times that we had a bear market, which means the value of the stock market dropped by 20% or more pretty quickly. And you can see with the red circles that in 6 of those times, even after a 20% drop, the stock market in the next 12 months continued to drop even more. So there's no proof that a 20% drop of the stock market means it's a buy signal. Now, if you take a look on the left column, you'll see during which of these crashes, the top one is the crash of 1929, the Great Depression, were we in a recession at the time that it occurred? We could be in a recession now, we don't know just yet. But you can see that if you look at just the times where we're in a recession, it's about a 50-50 coin toss if putting money in the stock market right now is a good idea or not. It's like going to Vegas and said, I'm going to put it all on red. You've got equal odds of making a good bet putting money in the stock market right now, historically speaking. So if you're getting this objection from your clients for looking at a commercial property or an investment property, this slide should take care of that objection right away. Let me know if I went through that kind of fast. If you have any questions, I'm happy to go through it again. Just let me know. So I don't think cap rates are going to change very much as we've seen this change in the interest rate environment. So let me show you the evidence I have, and I'd welcome any dialogue about contrapoints to it. So this chart shows you the 10-year Treasury, which is the government's preferred way of borrowing money. And you can see over the last 5 years that the rates bounced around from 2.5 to like 0.6. Currently it's at 2.9. So quite a roller coaster ride there. So when you hear the really scary headlines about how interest rates have gone up by more than 2% in a really short amount of time, what they're looking at here is bottom dead center, July of 2020, when we were really at the most scary time of COVID, and we all thought we might drop into a depression and we're going to lose millions and millions and millions of people. And the government did a lot to stimulate the economy. So the rates at that point were like 0.6, and they've gone to 2.9. So it's a 2%, 2.3% increase. And that's what people are commenting about. It's like this huge interest rate shock. I don't think that's really a fair comparison. I think a better comparison is say, what were the interest rates like right before we went into COVID? So that would be this yellow circle. You can see it's at 1.9%. So the real change in the interest rates is from 1.9 to 2.9, which is a 1% lift. So that's not nearly as dramatic as this 2.5% point that the media tends to scaremonger ourselves into. But even that really isn't true, because if you look back in like July or September of 2018, the interest rates on the 10-year were slightly higher than they are today. So we've gone from that point to really cheap for a period of time to where we were before. So just having some historical context about the interest rates is that we're about where we were about a year before COVID. So that's the first thing I want to point out. Is a 40-year trend for cap rates and for the 10-year Treasury. So you can see that the 10-year Treasury is the dashed line. It got as high as 14% back in the 80s when inflation was super duper high. And it's generally been trending downwards ever since. You can see that the cap rates generally just don't bounce around that much. They're really, really stable over time. So let's get a little bit more granular. If you take a look at the times when the mortgage rate, the 10-year Treasury rate went up by more than 1% in a year, just like what we just experienced, you can see this has happened 9 times. So it's not that unusual for rates to have a 1% increase like we just experienced. And if you take a look at what happened to the cap rates during those interest rate shocks, you can see they went down 0.3, down 0.3, down 0.4, down 0.2, up 0.1, down 0.1. The overall average is that they had 0.1% decline in the cap rate when the interest rates went up by 1%. Most recently, in 2022, the rates are up by 2.1% and cap rates were unchanged. He knows that, right? So let's look at it from the other side of the equation. And what happens when the interest rates drop suddenly by 1% or more? If it's true that the cap rate should go up when rates go up, then shouldn't it also be true that when cap rates go down, when interest rates go down, the cap rate should go down? And the answer is no, they don't. So here's 9 times in the last 40 years where interest rates suddenly dropped. And you can see that on average, the cap rates barely budged. They dropped by 0.1%, the exact same result as when the interest rates went up by 1% really quickly. So what this tells us is that the cap rates and the interest rates on the 10-year Treasury are largely unrelated. So a way to prove this to yourself is that if you take a look here, we had 10-year Treasury rates pretty much exactly the same as they are right now in the summer and fall of 2018. Then they dropped to almost nothing. Did the cap rates go down? No, they stayed almost exactly the same. And since this low period when we were trying to stimulate the economy out of COVID, the interest rates went up by 2%. Did the cap rates go up? No, they stayed the same. So if you've got concern that we're going to have an increase in the cap rates and as a result your commercial properties will be worth less, I cannot find any evidence to support that that's true. If you've got something, I would be just delighted to see it. So let me show you a chart I got from Joe Massey. So to recap, how does a cap rate impact the value of a commercial property? So the formula, just as a refresher, is you take your rents minus your operating expenses, and that gives you NOI, net operating income. Let's pretend that our office building or our multifamily produces $100,000 of NOI. If we take that, I'm going to take the middle case. We put a 5% cap rate on that. The NOI divided by the cap rate gives us a valuation of $2 million. So what if the cap rate drops by 0.1%? Well, we would take our NOI, which didn't change, on a 4.9 cap, and now the property's worth 40 grand more, 2% more, 2,040,000. On the other hand, if the cap rate goes up by 1/10, now the property loses 40 grand or 2%. There just isn't a lot of difference in commercial property valuations as the interest rates bounce around. Joe, what do you see in this?
You know, I see exactly what you're describing, and I always take it to a little bit more simple. Let's say I've got 2 or 3 condos, or maybe I've got 10 condos that are all worth $200,000, so it's a $2 million portfolio. Interest rates go up, the cap rate goes down by 0.1%. My portfolio doesn't change in value that much. Very, very little correlation. And if I have one $200,000 condo, interest rates changed, my value changed by $4,000. Very minimal. I think there's many other factors that are weighing in on increasing prices. And I love this stat that you picked up on and studied, because I think we do think that, right? Conceptually, interest rates go up, that's going to make our properties less valuable. But this really shows there's not a big correlation between those two particular criteria.
Yeah. So if you guys have a client that the only thing holding them back from the sidelines to getting into the game is this concern about cap rates, you've got some slides here to disarm this. This is a complicated topic. So, I mean, if you need to get Joe or I on the phone for 10 minutes with your client to explain it, I am delighted. There's nothing I can do that's more valuable with my time than spending a few minutes with you and your client on the phone, helping them to make a decision that buying a property right now is the right answer. So do not be bashful about asking one of the two of us to help you explain the economics, the truth, not the media, but the truth of what the situation is.